Okay, welcome everyone to the first of a four-part series about understanding business taxes. Please make sure you are muted for the duration of the presentation, and you can submit your questions in the chat. We'll be answering them throughout the presentation. This presentation will be recorded and published on the library's YouTube channel. Everyone who has registered will be emailed a link to the recording and sent a copy of the slides. I want to do just a shout out to a couple of the other tax programs at the Rochester Central Library. They are both funded by Empire Justice. We have the cash program that provides volunteer income tax assistance, where if you are within the eligibility, they could help file your taxes. Or they'll also be available if you want to have free self-assisted, so you do your taxes there and you'll have people on hand to assist you. And then there's also the low income taxpayer clinic. So if you have any troubles, such as refund delays, identity theft, liens and levies, tax debts, anything that could help you, that requires more of a legal opinion or advice, feel free to contact the Low Income Taxpayer Clinic. They both offices are located at the Rochester Central Library and the fourth floor, right next to us, the Business Insight Center, where we can provide you business research. And I will now introduce you to Jacqueline Kelly Myers, who will continue with the presentation.
Okay, great. Thanks, Melissa. Good evening, everyone. Thanks for joining me tonight. I am Jacqueline Kelly Myers, a stakeholder liaison located here in Rochester, New York. I am part of the Communication and Liaison Division within the Internal Revenue Service. In my current role, I collaborate, inform, and communicate our priority outreach messages to all our tax-paying communities, including small businesses and self-employed individuals. I joined the IRS in 2006, and I've held a variety of positions, including as a customer service representative in our walk-in office, otherwise known as the TAC office, and that is located at 255 East Avenue. I assisted taxpayers file their returns and resolve issues on their accounts, as well as respond to taxpayers' correspondence. I also worked as a tax examiner in office audit as what's called a tax compliance officer. Basically, that's an auditing role. In this role, I worked with individuals, small businesses, and their representatives to help them understand their tax compliance responsibilities and resolve their issues. Before joining the IRS, I worked both in banking and the insurance industries. The majority of my career has been working with the IRS in both customer service and compliance. Currently, I'm very pleased to be in a position to reach out to taxpayers directly, to educate them on ways to avoid costly mistakes, and help them file accurate returns to avoid being selected for examination. So with all of that said, let's get started with our first lesson, which is entitled Federal Taxes and Your New Business. So in our overview, in the lesson, I'm going to provide a basic summary of what you need to know about successfully operating your business, as well as provide you with some of the resources for additional information. Specifically, I'll explain the purpose of the employer identification number, describe basic record-keeping requirements for tax purposes, define basic bookkeeping and accounting methods, explain the forms of business organizations, define gig economy, and suggest how to select a paid tax preparer. Before I begin, however, I want to remind you that you need to also understand your state and local tax reporting requirements in addition to the federal requirements I will be describing here. Let's start first with the Federal Employer Identification Number, or EIN. An EIN identifies tax returns filed with the IRS, and as a business owner, you may be required to get an EIN. You need an EIN if you pay wages, have self-employed retirement plan, operate your business as a partnership or corporation, or you're required to file any of these tax returns: employment, excise, fiduciary, or alcohol, tobacco, and firearms. Your type of business may not be required to attain an EIN, but you may need an EIN for dealing with other businesses, including banks, that require an EIN to set up business accounts. The IRS will give you an EIN even if you don't need it for IRS purposes. The fastest and easiest way to get an EIN is online. Just go to our website at irs.gov, type in the phrase EIN in our search bar. From there, you'll find out more information, including the application. The EIN assigned is the Permanent Federal Employer Identification Number for your business. This EIN may be canceled if the name or Social Security number of the principal officer does not match the Social Security Administration records, or if your business already has an EIN. Now let's discuss record keeping for your business. As a business owner, you must keep receipts, sales slips, invoices, records for cash receipts for expenditures, bank deposit slips, canceled checks, and other documents to substantiate items of income, deductions, and credits. Although it may sound like a lot of work, unless you have records showing the source of your receipts, you may not be able to prove that some are non-business, therefore non-taxable. Remember, recording these items will help you pay only the correct amount of tax that you owe. Now let's look at how in-depth your records need to be and how long you need to keep them. Your records must support the claimed amount, the time and the place, the business purpose, and your business relationship to any other person involved. If your records are incomplete, they may not support your deductions. You must keep your records if their contents may be material in the administration of any Internal Revenue Service law. Usually, the statute of limitation for income tax return expires 3 years after the return is due or filed, or 2 years from the date the tax is paid, whichever is later. To support items of income or deduction on your tax return, you must keep records until the statute of limitation for that return expires. There are special record-keeping rules if the records are connected to a property. Generally, keep these records until the period of limitation expires for the year in which you dispose of the property. You must keep these records to figure any depreciation, amortization, or depletion deduction, and to figure the gain or loss when you sell or otherwise dispose of the property. If you receive property in a non-taxable exchange, your basis in that property is the same as the basis of the property you gave up, increased by any money you paid. You must keep the records on the old property as well as on the new property until the period of limitation expires for the year in which you dispose of the new property. If you have employees, then you must keep employment records too. You must keep all employment tax records for at least 4 years after the date on which the tax return becomes due or the tax is paid, whichever is later. There are some circumstances where records may have to be kept longer. If you change your method of accounting, records supporting the necessary adjustments may be material for an indefinite time. And as discussed earlier, records that establish the basis for original or replacement property must also be kept longer. If you lost your records due to circumstances beyond your control, such as flood or an earthquake, you may substantiate a deduction by reasonable reconstruction. For more information about record keeping, see publication 583, Starting a Business and Keeping Records. For information about employment tax records, see IRS publication 15, Employer's Tax Guide. You can find these publications at our website at www.irs.gov. You can also go to our website and search using the keyword record keeping. Okay, now let's discuss bookkeeping systems. Many people who operate their own one-person business never bother to set up a business bookkeeping system. Their personal checking account serves as both a personal and a business account. The IRS, however, recommends that you open a separate business bank account. There are two types of bookkeeping systems, single entry and double entry. The single entry system is the simplest to keep. With the single entry system, you record a daily and a monthly summary of business income and a monthly summary of business expenses. This system focuses on the business's profit and loss statement and not on its balance sheet. While single entry is not a complete accounting system, it shows income and expenses in enough detail for tax purposes. The double entry system is more complex. It has built-in checks and balances. It is self-balancing and is more accurate than the single entry system. Because all businesses consist of an exchange of one thing for another, double entry bookkeeping is used to show this twofold effect. Accounting methods. Once you've selected a bookkeeping system, you also need to select an accounting method. Your accounting method is a set of rules that you use to decide when and how you report your income and expenses. The two most commonly used accounting methods are the cash method and the accrual method. On your tax return, you must use the same accounting method you use to keep your records. Under the cash method, you report all income in the year you receive it. You usually deduct expenses only in the year in which you pay them. Under the accrual method, you report income in the year you earn it, regardless of when you receive payment. You deduct expenses in the year you incur them, whether or not you pay them that year. Businesses that have inventory for sale to customers must generally use an accrual method for sales and purchases. However, many small businesses with gross receipts averaging less than $10 million a year may use a cash method for sales and purchases. For more information on the difference between the cash and the accrual methods of accounting, see IRS Publication 538, Accounting Periods and Methods. There are computer software packages that are very useful, relatively easy to use, and require very little knowledge of bookkeeping and accounting. Be careful. If you use software, you must be able to produce records from the system to support what is on your tax return, and always keep a backup copy in a safe place. Okay, now I'm going to test your knowledge. Up to this point, we've covered quite a lot, and it's time to test your knowledge. Sandy is a business owner, and you decide whether she is using the correct accounting method. Sandy has a website where she sells custom ordered and handmade knitted goods, hats, scarves, and socks. Customers order online, but because it could take a few weeks or even a few months to get the supplies and finish the order, she doesn't charge them until the product ships. She uses the accrual method of accounting. She records the sale in the month when she ships the product, not in the month that the person orders it. Is Sandy correct in using the accrual method of accounting? So, how many people think she's correct? I don't know how many people we have in the chat, but does anybody think, let's do it the other way? How many people that think the cash method is the way she should go? So Tony thinks cash. We got one cash, we got one accrual. And I think we got two more that think she's doing it correctly in the accrual. Accrual. Okay, so accrual is kind of winning the day here. So for those of you who said accrual, let's see. Whoops, I jumped ahead there. Yes, Sandy can use the accrual method of accounting. This method can be used because there can be some length of time between when a customer places an order and when it ships. Sandy records revenue when the customer is charged. That is when she ships the order. So for those of you who said accrual, you did a good job. And for those of you who said cash, most businesses are cash-based, and it is kind of a mind shift to think about accrual. And sometimes it can really get very tricky, and you have to really sit with it and figure out what's the right way to go here. So good job, everyone. Next, let's talk about the type of business structures. We have 5 of them. Early in the life of your small business, you're going to need to decide on the structure of your ownership. You have sole proprietorship, partnership, corporation, S Corp, limited liability company. And for more information, you can go to our website and type /small biz with a Z, and click on business structure for more information. So a sole proprietorship is an unincorporated business that one person owns. Advantages of a sole proprietorship are it is the simplest type of business organization. The sole owner of the business has complete control over all decisions. The sole owner is not required to consult with anyone else to make decisions or changes. The disadvantages of a sole proprietorship are the business does not exist apart from the owner, and it is the owner who assumes the risks of the business to the extent of all of his or her assets, even if the owner does not use his or her personal assets in the business. Additionally, the ability to finance the business, known as capital, is limited to whatever the owner can come up with, including loans from financial institutions, of which the owner is personally responsible. A sole proprietor files his or her taxes using a Schedule C, net profit from business. The Schedule C is included with the Form 1040 to report the profit or loss from operating the business. The sole proprietor also files Schedule SE, self-employment tax, to report the Social Security and Medicare taxes on net profits of the current year's threshold. If you or your spouse jointly own and operate an unincorporated business in a non-community property state and share in the profits and losses, you are partners in a partnership and not a sole proprietorship. So you should not use Schedule C, but there are exceptions to this. For example, if you and your spouse wholly own and operate an unincorporated business as community property under the community property laws of a state, you can treat the business either as a sole proprietorship or a partnership. There's another exception for qualified joint ventures for spouses. If you and your spouse each materially participate as the only members of a jointly owned and operated business, and you file a joint income tax return for the tax year, you can make a joint election to be treated as a qualified joint venture instead of a partnership. This allows you to avoid the complexity of a partnership Form 1065, U.S. return of partnership income, but still gives each spouse credit for Social Security earnings on which retirement benefits are based. See publication 334, Tax Guide for Small Business for individuals who use Schedule C. The second type of business organization is a general partnership. A partnership is a relationship between two or more persons who come together to carry on a trade or business. Each person contributes money, property, labor, or skills, and each expects to share both in the profits or the losses of the business. Any number of persons may join in a partnership. The advantages of a partnership are that it is easy to organize, it has a definite legal status, and it may have greater financial strength than a sole proprietorship. The first disadvantage is that decision authority is divided. The other disadvantage to a partnership is that the liability of the partners is usually unlimited, unless otherwise stated in the partnership agreement. That is, each partner may be held liable for all the debts of the business. For example, if one partner does not exercise good judgment, that partner could cause not only the loss of the partnership's assets, but also the loss of the other partner's personal assets. Partnerships report profit or losses on Form 1065, U.S. Return of Partnership Income. Form 1065 summarizes the business activity of the partnership. A partnership does not pay tax on income from daily operations, and all the income, losses, deductions, and credits generated by a partnership pass through to the partners. Each partner gets a Form 1065, Schedule K-1, partner share of income, deductions, credit, etc. And the partners report these items on their personal income tax returns. Partnerships must still file employment tax returns and pay employment taxes on employees' compensation. If you would like more information about partnerships, see IRS Publication 541, Partnerships, as well as the instructions to Form 1065 and Form 1040. The third type of business organization is corporation. Corporations are treated by the law as legal entities. That is, the corporation has a life separate from its owners and has rights and duties of its own. The owners of a corporation are known as stockholders or shareholders, and it may be worth noting one person can be the sole shareholder of a corporation. Managers of a corporation may or may not be shareholders. Forming a corporation involves the transfer of money or property, or both, by the prospective shareholders in exchange for capital stock in the corporation. For purposes of federal income tax, corporations include associations, joint stock companies, and trusts, as well as partnerships that operate as associations or corporations. Let's cover advantages and disadvantages of corporations. The advantages of a corporation are that the stockholders have limited liability for corporate debts or actions. Transfer of ownership is easy, stock can be sold, and raising capital and expanding the business may be easier. The disadvantages are that the corporation is subject to tax on its income at the corporate level. And when the income is distributed as dividends, that income is taxed again at the shareholder level. Owners of a corporation who work in the business are typically considered employees, are paid a salary, and both the corporation and the employee pay employment taxes on that salary. It is wise to consult an accountant and an attorney specializing in corporate law, as corporations may be more difficult and expensive to organize than other business structures. Additionally, the corporate charter filed with the Secretary of your state restricts the type of business activities and is subject to many state and federal controls. File Form 1120, U.S. Corporation Income Tax Return. See Publication 542, Corporations, for more information. The fourth business structure is the S corporation. An S corporation is a small business corporation whose shareholders elect to report corporate profit or losses in the same manner as that of a partnership. Like partnerships, S corporations do not pay tax. Unlike S corporations, C corporations are taxed at the corporate level. Then when the income is distributed as dividends, it's taxed again at the shareholder level. Organizing shareholders of a corporation who wish to avoid double taxation can file Form 2553, election by a small business corporation. This election must be submitted by the 15th day of the third month of the first S corporation year. Let me give you an example. to help clarify the process. If you file S corporation tax year begins on January 1st, you must submit Form 2553 by March 15th. Otherwise, the election is effective for the next tax year. The IRS will send you a CP 261 notice of acceptance as an S corp. To let you know it was received and approved, and we approved your election. You should receive your approval in 60 days. If you do not, contact the IRS campus where you filed your Form 2553. For more information, see the instructions on Form 2553. An S corporation does not pay tax on income from daily operations. All income, losses, deductions, and credits generated by an S corporation pass through to the corporate shareholders. The shareholders then report the items on their personal income tax return. However, there are situations where S corporation is subject to an entity or corporate level tax. For example, S corporation officers who provide services to their corporation are employees, and their compensation is subject to employment taxes. By law, officers of corporations are employees for employment tax purposes, and their compensation is wages. An S corporation must pay reasonable compensation or wages to a shareholder employee in return for the services the employee provides the corporation before a non-wage distribution may be made to that shareholder employee. In other words, they must be compensated first, then they get the distribution. An S corporation has the combined advantages and disadvantages of partnerships and regular corporations. S corporations file Form 1120S, U.S. income tax return for an S corp. The S corporation provides each shareholder a Form 1120S, Schedule K1, shareholder share of income deductions and credits. The shareholder uses the Schedule K1 to complete Part 2 on Form 1040 Schedule E, supplemental income and loss, as well as any other forms and schedules the shareholder must file with the individual return. The final structure we will discuss is Limited Liability Company, LLC, a legal entity created under state law. The advantages and disadvantages vary. The LLC is separate from its owners, who are referred to as members. An LLC can own property, incur debts, and enter into contracts. LLCs are popular because owners or members are personally protected against the LLC's debts, have limited personal liability for the debts and actions of the LLC, and without many of the formalities of a corporation. This is an advantage for this type of business organization. Other features of LLCs are more like partnerships, providing management flexibility and the benefit of flow-through taxation. For federal income tax purposes, an LLC may be treated as a sole proprietorship, a partnership, or a corporation. Also, for federal tax purposes, owners or members of an LLC can make an election to be treated either as a disregarded entity or a partnership. If you want to tell the IRS how to treat your business for federal income tax purposes, you need to file Form 8832, Entity Classification Election. If you do not file Form 8832 for tax purposes, the IRS will treat your business as a sole proprietorship if it has a single owner, or as a partnership if it has two or more members. Note that even though the LLC is treated as a sole proprietorship for tax purposes by the IRS, the single member owner of the LLC generally maintains limited personal liability protection from the debts and actions of the LLC, unlike an actual sole proprietorship where the owner would be equally liable for the debts and actions of the sole proprietorship. There are instructions with the form that explain the classifications. If you disagree with the default classification, you can file Form 8832 to request a change. Sharing or gig economy. The gig economy income is taxable. If you earn income as a rideshare driver, rental host, or online seller, your business is part of the gig economy. The gig economy, also called sharing economy or access economy, is any activity where people earn income providing an on-demand work, services, or goods. Often it's through a digital platform like an app or website. Visit the irs.gov Gig Economy Tax Center, where you will find general information about tax issues that arise in the gig economy and how to file your taxes. Choosing a paid preparer. This is the last topic for this lesson, choosing a paid preparer. If you do decide to use a paid preparer, remember that you are still legally responsible for the information on your own tax return. Let's review some points you need to be aware of. First, avoid preparers who claim they can obtain larger refunds than others. Second, avoid preparers who base their fees on the amount of your refund. Also avoid paid preparers who won't sign the tax return or won't give you a copy for your records. Fourth, never sign a blank tax return and never sign a completed form without reviewing it and making sure you understand the return. Finally, consider whether the preparer will still be available to answer questions about the return for months or even years after the return is filed. The IRS now has a registration and certification process for preparers. To ensure that you are working with an honest and reputable preparer, make sure that the paid preparer has a valid IRS preparer tax identification number, also known as a PTIN. All preparers, whatever their professional designation, must have a valid PTIN. You can find more tips on irs.gov. Simply type choosing a preparer in the search box. There are variations, however, in the type of return preparer, the testing they must undergo, their continuing education requirements, and their practice rights before the IRS. I will discuss specific types of preparers, enrolled agents, CPAs, and attorneys, annual filing season program record of completion, and PTIN holders. First, the enrolled agent is a person who has earned the privilege of representing taxpayers before the Internal Revenue Service. Most enrolled agents have passed a 3-part comprehensive IRS test covering individual and business tax returns and client representation rules. They must adhere to ethical standards and complete 72 hours of continuing education courses over 3 years. Enrolled agents have unlimited practice rights, which means they are unrestricted as to which taxpayers they can represent, what types of tax matters they can handle, and which IRS offices they can represent clients before. To learn more about enrolled agents, see Treasury Department Circular 230 or visit irs.gov. You can type in the enrolled agent in the search box. Some individuals become enrolled agents through experience as a former IRS employee instead of passing the 3-part test. These individuals may be limited in their practice rights to only the matters they have expertise in as a former employee. I would qualify for an enrolled agent if I so desired to do so, based on my prior experience here. CPAs and attorneys, both the CPAs and attorneys, also known as CPA and attorney, have their own professional requirements for continuing education. Both groups have unlimited practice rights before the IRS for obvious reasons. They have a much higher level of education and experience. The annual filing season program participants, this is a voluntary program that recognizes the efforts of return preparers who are generally not attorneys, certified public accountants, or enrolled agents. It was designed to encourage education and filing season readiness. The IRS issues an annual filing season program record of completion to return preparers who obtain a certain number of continuing education hours in preparation for a specific tax year. Beginning with returns filed after December 31st, 2015, only annual filing season program participants have limited practice rights. This means they may only represent clients whose returns they prepared and signed, but only before revenue agents, customer service reps, and similar IRS employees, including the Taxpayer Advocate Service. They cannot represent clients whose returns they did not prepare, and they cannot represent clients regarding appeals or collection issues, even if they did prepare the return in question. PTIN holders. They are tax return preparers who have an active preparer tax identification number, but no professional credentials, and do not participate in the annual filing season program, are authorized to prepare tax returns. Beginning January 1, 2016, this is the only authority they have. They have no authority to represent clients before the IRS, except regarding returns they prepared and filed December 31st, 2015 and prior. Directory of Federal Tax Return Preparers with credentials and select qualifications to help taxpayers determine return preparer credentials and qualifications. The IRS has a public directory containing certain tax professionals. The searchable, sortable database includes the name, city, state, and zip code of attorneys, CPAs, enrolled agents, enrolled retirement plan agents, and enrolled actuaries with valid PTINs for 2016, as well as annual filing season program record of completion recipients. You can find the directory of federal tax return preparers with credentials and select qualification on our website at irs.gov. So that completes lesson 1. I know that was a lot of information presented in a pretty short period of time. But everything that I presented can be found on our website at www.irs.gov. And before I move to lesson 2, do we have any questions? Does anybody want to come off mute and ask any questions or place any questions in the chat? Or are there questions in the chat that I missed?
Hi, Jacqueline.
Hi.
It's Kira here.
Hi.
I just had a question. I'm a sole proprietor,
Okay.
but I have kind of like 2 streams of revenue. Do I report that just under one kind of filing, or do I need to do 2 filings for that in terms of tax?
Are they two different types of businesses? 2 distinct?
Yeah.
Okay. You would file 2 separate Schedule Cs. You would file one Schedule C for one business and one for the other.
Okay.
Does
Cool.
that make sense?
I don't. Yeah. I don't need to do like a doing business as or anything like that for one of them. I can just do 2 separate ones, Schedule Cs.
Correct. And then the net profit and loss from both businesses will flow through to your Schedule SE.
Got you. Okay, cool.
You'd file one Schedule SE, and that would net out your profit or your loss.
Got you. Thank you. That's very clear.
You're welcome. Very good question. Thank you for asking. Okay, what info did we need to save with our receipts when filing? You're going to need to indicate on the back of the receipt what the item was that you purchased if it doesn't show it on the front of the receipt. And along with that, you need to be careful with some of the receipts that you get from particular stores, because the ink tends to fade. So I think they say to put them in like those like plastic bags to, keep the moisture off of them. And just have a record of, what that item was purchased for. So if it's something that could also be if it's an item that could also be considered something that you would use personally, you would want to say, for example, toilet paper or paper towels, you know, you would use them in your shop, you know, for business purposes as opposed to, you know, um, items that you purchase for home. What else? I'm trying to think what else. We'll kind of get more into entertainment in lesson number 2 as far as receipts are concerned. But definitely having more documentation is far more preferable than having less. Because if you're audited, you're going to want to have a paper trail. You don't want to get that letter and not have an idea where things are. You know, what you purchased, and why you purchased it, for what reason. So if you are a business owner, you want to make sure you keep your receipts. Having credit card statements as a backup isn't bad, but the credit card statements alone or bank statements alone will not suffice. We need to see the receipt. It needs to have the time and the place and the business purpose, which you don't get with the credit card statements and the bank statements, which a lot of people tend to rely on. So it's not that it's not good, but those statements alone will not suffice in most instances. But as I said in the lesson, if you're in the lurch because of, you know, something horrific like, you know, a Hurricane Helene, obviously those people lost everything. So we're not going to expect that you're going to be able to, you know, retrieve receipts to present during an audit. So if you should happen to find yourself in that situation. Are photos of the receipts okay? I would lean towards no. I mean, who's to say they're actually your receipts and not someone else's? I mean, if you want to do that as a backup in the event that you should happen to lose the receipt or the receipts become illegible, that's not necessarily a bad idea. But to rely on that wholeheartedly, no, we typically want to see the receipts. So we put them in Excel spreadsheets, we do our own tallying. So the photos are generally not sufficient. We want to see the receipts. Let me see, did I answer all the questions up here? What info did we need to say with our receipts when filing? Answer that. With an LLC, I read that the business must file as a disregarded entity. What does that mean? That's funny you asked that. To be honest with you, I really don't 100%, I'm not 100% sure in my answer to you, so I'd have to look that up and get back to you. I think it means that it would be considered just like a sole proprietorship for taxation purposes, but I think that it did state that there was a form you could file. So let me look into that, and if you're okay with me getting back to you on that, I will do that. So you registered with Melissa for this event, so I can get to Melissa with the answer and she can get that back to you. Oh, we have somebody with an answer here. It means that your income taxes are reported under your personal Social Security number. Okay, thank you so much. Someone knows. So with an LLC, you're not liable. You don't have any personal liability as far as the state is concerned, but your income is reported under your Social Security number, as stated here. All righty. Any other questions? Some good questions coming in here. You guys are good. All righty. We are going to move into lesson 2. Righty. And it's Schedule C and other small business taxes. So in this lesson, I'll provide an overview of qualified business income deduction, or QBI. It's an overview on Form 1040, Schedule C, profit or loss from business, and discuss how to calculate gross profit and gross income, show you how to identify and deduct expenses and how to calculate the net profit or loss. I'll also cover some areas on Form 1040 U.S. individual income tax return that may be of interest to small business owners. And I'll also discuss self-employment tax and estimated tax. I'll provide you with references for more information. So let's get started. Qualified business income, or QBI, is part of the Section 199A deductions that started in December of 2017. Many individuals, including owners of businesses, operated through sole proprietorships, partnerships, S corporations, and some trusts and estates may be eligible for a qualified business income deduction, also called the Section 199A deduction. The deduction is found in tax law enacted in December of 2017, and it allows eligible owners of businesses to deduct up to 20% of their qualified business income. Business owners can also claim 20% of qualified real estate investment trusts, REITs, REIT, dividends, and qualified publicly traded partnership income, PTP income. Income earned by a C corporation or by providing services as an employee isn't eligible for the deduction. The deduction is available for tax years beginning after December 31st, 2017. QBI is the net amount of qualified items of income, gain, deduction, and loss from any qualified trade or business, including income from partnerships, S corporations, sole proprietorships, and certain trusts. These includable items must be effectively connected with the conduct of a trade or business within the United States. Generally, in computing QBI, business owners must account for any deduction attributable to the trade or business. This includes, but is not limited to, the deductible part of self-employment tax, self-employed health insurance, and deductions for contributions to qualified retirement plans, such as simplified employee pension, SEP plans, savings incentive match plan for employees of small employers, simple, and qualified plan deductions. To complete a Schedule C, you'll first fill in standard information about yourself and your business. You'll also notice that there's a place for you to enter a principal, business, or professional activity code. This is line 8. It's right there in the red. These codes are based on the North American Industry Classification System, and the Schedule C instructions contain a list of the 6-digit codes. If any part of your gross receipts is from the sale of products, you'll need to know all the terms I am going to discuss. And those terms are gross receipts and returns and allowances, cost of goods sold, gross profit and gross income, bartering, expenses, car and truck depreciation, legal and professional services, and office expenses, supplies, travel, meals, and entertainment, and net profit or loss. Gross receipts and returns and allowances. The first term is gross receipts. Gross receipts are the income that a business receives from the sale of its products or services. The second term is returns and allowances. Returns and allowances include cash or credit refunds you make to customers, rebates, and other allowances off the actual sales price. Individuals who don't make or buy products for resale as part of their business don't have returns or allowances to deduct from gross receipts. The third term is cost of goods sold. Cost of goods sold is the cost to a business to buy or make the product that is sold. It is easy to calculate the cost of goods sold if you sell all your merchandise during the year. However, some of your sales will probably be from inventory that you carried over from earlier years, and you will probably have inventory left unsold at the end of the year. To calculate the cost of goods sold, start with the cost of the inventory on hand at the beginning of the year. Add the cost of additional goods purchased or manufactured during the year. Be sure to subtract the cost of any merchandise withdrawn for personal use, such as food a grocer may take home or gasoline a garage owner may give to his relatives. The result is the cost of items available for sale during the year. Oh, got one thing here. Then subtract the value of your inventory. At the end of the year, your cost of goods sold is the remainder. This calculation is in part 3, cost of goods sold on schedule in Schedule C. The fourth term is gross profit. To calculate gross profit, first subtract the returns and allowances from total gross receipts. Then subtract the cost of goods sold from that difference. Then add other income. This includes bartering income. I will talk more on bartering on the next slide. The final term for this section is gross income. Gross income is simply the sum of gross profit and other income. See the instructions for Schedule C for more information on what counts as other income. Bartering. Bartering occurs when you exchange goods or services without exchanging money. An example of bartering is a plumber doing repair work for a dentist in exchange for dental services. The fair market value of goods and services must be included in the income of both parties. Income from bartering is taxable in the year in which you receive the goods or services. See the section on bartering in the IRS publication 525, taxable and non-taxable income. Now I'm going to talk about your day-to-day ordinary and necessary business expenses. Expenses must be considered ordinary and necessary business expenses in order to be deducted. I encourage you to see IRS publication 535, business expenses, for more information. The first expense I'm going to discuss is car and truck expense. If you use a car for business only, you may base your deduction on the full cost of operating it. If you use a car for both business and personal purposes, you must divide your expenses between those uses based on mileage to compute a business percentage. Do not include commuting to and from your place of business as business mileage. You may take a deduction for your actual business expenses for the car or use a standard mileage rate. Actual business expenses include gas, oil, repairs, insurance, depreciation, tires, and license plates. Standard mileage means multiplying your business miles by the standard mileage rate. For this year's rate, check the IRS website at www.irs.gov. To reduce record-keeping burden, if you use no more than 4 vehicles at the same time for business purposes, you may use a standard mileage rate. However, to use the standard mileage rate on a vehicle after the first year of business use, you must have used the standard mileage rate in the first year. In later years, you can choose between either the standard mileage rate or actual expenses. This option is not available to you if you claimed actual expenses in the first year of business use. Actual business expenses include gas, oil, repairs, insurance, depreciation, tires, and license plates. Under either method, parking fees and tolls are deductible. If you do claim any car or truck expenses, you must provide certain information or the use of your vehicle on Schedule C, Part 4, information on your vehicle. Complete this part only if you are claiming car or truck expenses on line 9 of Schedule C and are not required to file Form 4562, depreciation and amortization, including information on listed property. See the instructions for Schedule C for more information. The second expense is depreciation. Depreciation is the annual deduction allowed to recover the cost or other basis of business or investment property having a useful life substantially beyond the tax year. Depreciation starts when you first use the property in your business or to produce income, and it ends when you take the property out of service, deduct all your depreciable costs or other basis, or no longer use the property in your business or to produce income. Do not depreciate land, inventory, or property you placed in service and disposed of in the same year. There are two main methods of depreciation: the modified accelerated cost recovery system and the Section 179 deduction. The method for depreciating most tangible property, that is property you can see or touch, is the modified accelerated cost recovery system. It is commonly referred to by its initials, MAKERS, and pronounced makers. The general rule of Section 179 allows taxpayers other than trusts, estates, and certain non-corporate lessors to elect to expense rather than capitalize and depreciate the cost of 179 property they purchase and place in service during the taxable year. Taxpayers can elect on Form 4562 to expense the cost of Section 179 property. The deduction amount of the elected Section 179 expense that can be deducted in any taxable year is limited to the aggregate amount of taxable income for such taxable year that is derived from the active conduct by the taxpayer of any trade or business. IRS Publication 946, How to Depreciate Property, explains all about makers in the Section 179 deduction, what property does and does not qualify for the 179 deductions, what limits apply, and how to elect it. In summary, for purposes of Section 179, taxpayers must elect to use Section 179. The Section 179 deduction is limited to the amount of taxable income from any active trade or business. And finally, it does not apply to property held merely for the production of income, such as investment property, or used in an activity not engaged in for profit. Tax Cuts and Jobs Act, or the TCJA, passed in December of 2017, made several significant changes to tax law, which affect individuals and businesses. For example, TCJA of 2017 modified Section 179 for tax years beginning after December 31st, 2017. The new tax law increases the maximum amount a taxpayer may expense under Code Section 179 to $1 million and increases the phase-out threshold, also known as the investment limitation amount, to $2.5 million. The $25,000 limit for sport utility vehicles remains unchanged. These amounts are indexed for inflation for tax years beginning after 2018. The TCJA of 2017 also made changes to the additional first-year depreciation deduction, which is often referred to as bonus depreciation. Unlike Section 179, which is subject to taxpayer making election, bonus depreciation is mandatory unless taxpayers opt out. The new law increases bonus depreciation from 50% to 100% for qualified property acquired after September 27, 2017, and placed in service after September 27, 2017, and before January 1, 2023. The 50% bonus depreciation rule will continue to apply to qualified property that a taxpayer acquired before December 28, 2017, and placed in service before January 1, 2018. The TCJA of 2017 also increases the depreciation limitations for passenger automobiles used more than 50% for business purposes and placed in service after 2017, depending whether bonus depreciation was claimed. If bonus depreciation is not claimed, depreciation is limited to $10,000 in year one, $16,000 in year two, $9,600 in year three, and $5,760 in all subsequent years. If bonus depreciation is claimed, the depreciation limit for passenger automobiles acquired after December 27, 2017, and placed in service after 2017 is $18,000 for year one, $16,000 in year two, $9,600 in year three, and $5,760 for all subsequent years. These amounts are adjusted for inflation after 2018. Additionally, the Tax Cut and Job Act of 2017 expands the definition of Code 179 property to include certain depreciable tangible property. It is used predominantly to furnish lodging or in connection with furnishing lodging, and expands the definition of qualified real property eligible for Code 179 expensing. This includes any of the following improvements: roofs, heating, ventilation, and air conditioning, fire protection and alarm systems, and security systems to non-residential real property that's placed in service after the date such property was first placed in service. The instructions for Form 4562, depreciation and amortization, provide general guidance on how to claim deduction for depreciation and amortization. Make the election under Section 179 to expense certain property and provide information on business investment use of automobiles and other listed property. The third and fourth expenses are those for legal and professional services and office expense. Included in these expenses are fees charged by accountants and attorneys that are ordinary and necessary expenses directly related to the operating of your business. Also included are fees for tax advice related to your business and for preparation of the tax forms related to your business. In addition, under the category of office expense, include expenses for office supplies and postage. The fifth expense we want to talk about is the supplies expense. In most cases, you can deduct the cost of materials and supplies only to the extent you consumed and used them in your business during the tax year, unless you deducted them in the prior tax year. You can also deduct the cost of books, professional instruments, equipment, etc., if you normally use them within a year. If the usefulness, however, extends substantially beyond the year, you must generally recover their cost through depreciation. Travel, meals, and entertainment. Although Tax Cut and Jobs Act, TCJA 2017, law and eliminated the deduction for any expenses related to activities generally considered entertainment, amusement, or recreation. Businesses may continue to deduct 50% of the cost of business meals if the business owner or an employee of the business is present and the food or beverage are not considered lavish or extravagant. Beginning January 1, 2021 through December 31st, 2022, businesses can claim 100% of their food or beverage expenses paid to restaurants as long as the business owner or employee of the business is present when food or beverages are provided and the expense is not lavish or extravagant under the circumstances. The meals may be provided to a current or potential business customer, client, consultant, or similar business contact. Food and beverages that are provided during entertainment events will not be considered entertainment if purchased separately from the event. For the travel part of travel and meals, enter your expenses for lodging and transportation connected with overnight travel for business while away from your tax home. The term tax home refers to your main place of business, regardless of where you maintain your family home. For the meals expenses, enter the total deductible business meal expenses. This includes expenses for meals while traveling away from home for business and for meals that are business related. Business meal expenses are deductible only if they are directly related to or associated with the active conduct of your trade or business, not lavish or extravagant, and incurred while you or your employee is present at the meal. Furthermore, instead of basing your deduction on the actual cost of your meals while on business travel away from your home, you can use the standard meal allowance for your daily meals and incidental expenses. Under this method, you deduct a specified amount depending on where you travel, instead of keeping records of your actual meal expenses. You must keep records, however, to prove the time, place, and business purpose of your travel. The standard meal allowance is the federal M&IE, that is the meals and incidental expense rate. You can find these rates on the U.S. General Services Administration website at www.gsa.gov. Click on the per diem rates link from there. You can search by city and state or by zip code. In most cases, whether you use the actual cost or standard meal allowance, you can deduct only 50% of your meal and entertainment expense, including meals incurred while away from home on business. For more information on travel, meal, and entertainment expenses, see IRS Publication 463, Travel, Gift, and Car Expenses. And as we mentioned earlier, IRS Publication 535, Business Expenses, tells you all about business expense deductions. Next, you must enter your net profit or loss. Net profit or loss is the amount by which the gross profit and any other income for a period is more or less in a loss or more or less in a loss than the business expenses and depreciation for the same period. To calculate net profit or loss on Schedule C, start with gross profit. Add other income equals gross income. That's on part 1. Then subtract the total expenses for the business on part 2. Business use of your home. Then you get the tentative profit or loss. Subtract expenses for, oh, that's not right. Well, from the gross income, you're going to subtract all of your expenses, your total expenses, as well as business use of your home, and it's going to net out to either a profit or a loss. You will follow the instructions on Schedule C, and hopefully it will wind up being a profit. You will report this profit or loss on Schedule 1 on your Form 1040 or 1040 SR and on Schedule SE. You can find more information on this topic in this lesson, Business Use of Your Home, as well as publication 587. Now, there are a few deductions on the Form 1040 that we wanted to bring to your attention. The first is health insurance. If you're not covered by an employer-subsidized health insurance plan, you may be able to deduct 100% of your health insurance premium on Form 1040. This applies to an individual or a family health insurance plan. For additional information on health insurance deductions, see IRS Publication 535, Business Expenses. Second, if you were self-employed or a partner, you may be able to take a deduction on Form 1040 for self-employed, SEP, simple, or qualified plans. See IRS Publication 560, Retirement Plans for Small Businesses, for more information. Business startup costs. Startup costs are amounts the business paid or incurred for creating an active trade or business, or investigating the creation or acquisition of an active trade or business. Startup costs include amounts paid or incurred in connection with an existing activity engaged in for profit and to produce income in anticipation of the activity becoming an active trade or business. Qualifying costs. A startup cost is recoverable if it meets both of the following requirements. It's a cost a business could deduct if they paid or incurred it to operate an existing active trade or business in the same field as the one the business entered into. It's a cost a business pays or incurs before the day their active trade or business begins. Self-employment and estimated tax. Now let's turn our attention to these two additional forms of taxation. Self-employed people who are sole props or partners in a partnership may be subjected to self-employment tax. Self-employment tax consists of Social Security and Medicare taxes. When you are an employee, your employer pays half and you pay half. When you are self-employed, however, you pay 100% of the cost. If your net profit from self-employment is $400 or more, then you must file Form 1040 Schedule SE self-employment tax. The IRS urges all employees, including those with other sources of income, such as self-employment, to check their withholding, do a paycheck checkup. This will help them avoid an unexpected year-end tax bill and possibly a penalty in the future. The easiest way to do this is to use a tax withholding estimator located on our website at irs.gov. Finally, when you're self-employed, you may have to pay what's called estimated tax. You know that when you work for someone else, they withhold federal taxes from your pay throughout the year. Well, when you're self-employed, you take care of this by paying estimated taxes throughout the year. Estimated tax payments are used to make payments against any self-employment tax and income tax liabilities you will have at the end of the year. They are associated with your business. A companion publication, Publication 505, Tax Withholding and Estimated Tax, has more details, including worksheets and examples to help taxpayers figure out whether they should pay estimated tax. Among taxpayers who should consult Publication 505 are those who have dividend or capital gains income, owe alternative minimum tax, or have other special situations. Form 1040 ES, estimated tax for individuals, can also help taxpayers figure these payments simply and accurately. To determine if you must pay estimated tax, use Form 1040 ES to estimate your taxable income for the year.
Your audio went off.
Oh, did it?
Oh, nope, never mind. It's my computer, I think. Okay, we're set.
Okay, great. To determine if you must pay estimated tax, use Form 1040 ES to estimate your taxable income for the year. Include your self-employment income and all other taxable income. You generally must make estimated tax payments. If you expect to owe taxes, including self-employment tax of $1,000 or more when you file your tax return, use Form 1040-ES to calculate and pay the tax. For more information on estimated tax, see IRS Publication 505, Tax Withholding and Estimated Tax. If you or your spouse also receive salaries and wages, you may be able to avoid having to make estimated tax payments on your other income by asking your employer to take more tax out of your earnings. To do this, file a new Form W-4, Employee Withholding Allowance Certificate, with your employer. Making estimated tax payments is easy now that most of the paperwork has been eliminated. The Electronic Federal Tax Payment System, also called EFTPS, makes it possible to pay online or over the phone or through IRS Direct Pay Online. You can learn more about EFTPS in the segment on how to file and pay your taxes electronically at our website, www.irs.gov, by clicking on the EFTPS link on the home page or at www.eftps.gov. Each year, the combined amount of wages, tips, and net earnings subject to Social Security withholdings change. You do not have to withhold any more Social Security taxes once that combination reaches that limit. This is known as the wage-based limit, and this limit is published annually in the IRS Publication 15. If you receive wages in addition to self-employed income, then subtract those wages from the maximums to calculate how much self-employment income is subject to taxes. If you have income subject to self-employment tax, you calculate the self-employment tax on Schedule SE. If you have more than one business, use one Schedule SE and combine the profit and losses from all businesses. This applies to sole proprietors and partners. All of your combined wages, tips, and net earnings in the current year are subject to any combination of the 2.9% Medicare part of the self-employment tax, Social Security tax, or Railroad Retirement Tier 1 tax. In this lesson, we review the basics of Schedule C, including what business owners need to know to determine gross profit and income, to identify deductible expenses, and to calculate net profit or loss. We also covered some areas on Form 1040 that may be of interest to small business owners. Finally, we covered self-employment tax and estimated tax. Remember, more information on these topics can be found in other lessons of this workshop and in the IRS publication referenced throughout this presentation, including IRS Publication 334, Tax Guide for Small Business, and at the Small Business and Self-Employed Tax Center at www.irs.gov/smallbiz with a B-I-Z. And that concludes lesson 2 for this evening. My contact information is here, over here on the right. 255 East Avenue in Rochester, 14604. My desk phone is 585-262-1164. My cell phone is 585-910-3949. And my fax that comes directly to my computer is 888-727-9249. And I can also be reached by email at Jacqueline, JACQUELINE .m as in Mary .Myers, MYERS at irs.gov. And are there questions that either you want to come off mute or you want to put them in the chat? I know lesson 2 was a lot more involved than lesson 1. Yes, I can go back to QBI. What question do you have about QBI? What do you have a specific? Okay. Um, I don't have, you will get a copy of the slides. I don't have an example right now of how to calculate it. But when you go through the actual, an actual tax return form, it brings you through a computation of how to compute the qualified business income. This just gave you a general overview to say that you can get a deduction of up to 20% if you meet the qualifications for it. It's done, I believe it's done after. Yes. It's actually it's a pretty hefty deduction. Yeah, I think so. I think they made some major tax changes with the Tax Cuts and Jobs Act, where they got rid of meals because it was just it was kind of, we were getting pummeled with that one. And that's where I was warning people about the actual keeping the receipts, who you entertained, when did you entertain them, what was the business purpose, were they a potential customer, client, were they a consultant, what did you discuss? Did they become as a result of, your interaction, did they become a client? Things of that nature. You're welcome, Veronica. Groceries would not be covered, only eating out, yeah. I should say typically groceries wouldn't be covered. I mean, if you're buying groceries to have a prepared, meal for a large number of clients, yeah, it could be covered, But once again, you'd have to have, detailed records, all the receipts, who was there, So I wouldn't rule it out altogether, but I would say typically they're not covered unless you can demonstrate there was a business need. Yeah. Okay, Tony, thanks for joining us. Okay, Kelly. Anyone else? Thank you. So before I let you all leave me for the evening, is there any feedback that I can take back to the IRS on how we can do things better? Are there questions, concerns, comments? Has anyone noticed any improvements in the past year as to how we respond to your inquiries? There was a massive amount of money given to us to improve our customer service that we haven't seen in quite some time. We hired way more phone assisters. The wait times should have been cut down significantly. There was an option to get a call back instead of waiting on the line. Some of your questions could be answered. You could answer your own question by entering certain data in online. So I'm just kind of curious if anyone found found it a better experience to interact with us. Oh, you have. Great. Do you have any specific examples, Tony, that I could share? Okay, cool. I'm all ears and eyes. Okay. Yes, wait times have been significantly lowered. Anything else? Anybody else? Feel free. Now's your time to let us have it. Great, great. Thanks, Barb. I appreciate it. There's been a heavy investment on online tools and telephone improvement. Oh, that's good. Great. Yeah, there was heavy investment in these things. So I'm glad to get the positive feedback. Okay, somebody said it's easier to navigate. Yep, the fact that I'm here and available to answer questions means a lot of improvement. Yes, the fact that I am here is a direct result of the passage of the Inflation and Reduction Act, because this position where I am located currently had been vacant due to attrition for, I don't even know, I venture to say between 5 and 10 years. So this particular area has been without a liaison for that length of time. So I'm pleased as I'm pleased to be here. I love the job. I love being able to be a resource for taxpayers. And I know how frustrating it can be to have a question and not know where to go to get an answer, or feel as though you could place a phone call, be on hold for an hour or longer, and then get the call disconnected. How frustrating is that? So, excuse me. Yes, 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 and yes. Okay, I'm trying to get to everybody. I don't. Okay, Veronica, I almost missed you. Okay. I apologize. I don't know where you can take the CPE credits for tax preparers. Um, Trying to think. I don't even know where to send you. Okay, hold on. Where to go? Well, let me ask you this. Are you um, an enrolled agent? Are you a CPA, attorney? Veronica, have you prepared taxes before? Okay, somebody's responding down here. No worries. Thank you for this class. It's very important. Okay. All right. Yeah, unfortunately, the CPAs online, you can go to our website and ask for a list of CPAs that are available in your area. I don't know if that's what you were asking for. I don't know how to pronounce your name, Thureiya. I don't want to butcher your name.
Oh, it's fine. Tereya, that's my name.
Oh, Thureiya. Oh, okay, cool. Okay, yes, and there's apps to track your receipts and deposit. Awesome. Okay, tremendous. Awesome. Oh, good. I'm so glad you found the lesson helpful. Yes, you would deduct the costs for marketing, the product packaging, and includes the sales tax. Yes, indeed. Yes, and the tools are very user-friendly. I do have another presentation on how to access our online tools, how to set up your own online account, so that if you have a question about how much money you owe, if you want to set up your own payment arrangement, if you want to know what your AGI was for the last year so you can file your tax return, all of that information is available and readily available at your fingertips. You just have to set up your own online account, and you can do that very easily by going to our website, irs.gov, and there's links there for online account. And you just click that blue link and it walks you through step by step and how to do that. So, okay, good night, Tony. Thanks for coming. All right, Kelly, thanks for joining. All right. I think I answered everybody's question. I don't know, Melissa, do you see anything that I haven't?
Nope, I think you covered all of them.
Okay.
So, but if you have any questions, you could come back next week, next Wednesday, and ask them then.
Yes. Good night. Good night, Barb.
But
Okay, thanks everybody for your attention. I appreciate it. I'll send copies of the slide to Melissa and she can distribute them.
yes, you should be able to get them next by the end of the week. We'll have them sent out, as well as having this lesson on YouTube. So if you need to review anything, it's will be freely available to anybody to rewatch.
Okay.
Okay, so that would be the end of our program for today, and I hope to see you all next week.
Yes. Good night, everybody.